my rule that contains the 30-day low is what I call the 30 in 30 golden rule. The 30 in 30 golden rule. The 30 in 30 golden rule is a 30-day low, and the 30-day, the stock's making a new 30-day low, and you happen to look up the next earnings announcement date, and the next earnings announcement date, so 30-day low, we're looking back. The other 30 is we're looking forward. And the 30 in 30 golden rule says if the stock is making a new 30-day low and you're 30 days or less to the next earnings in the future, then it's a double doo-doo. And you need to know about it. You need to be aware. I'm not saying that very second you sell it, but A, you better know if that's happening, and B, and so because I don't know what your context is. You could have climbed $100 run in your stock. You could have a cost basis so low, and maybe you decide, okay, I'm thinking like 4 things at once. So I don't know what the context is. Okay, that's a big deal, but you definitely want to know that you're in a violation of the 30 and 30 golden rule. And what could you do? Well, you could sell everything. That's a choice. You could sell some. I would say to not buy more of the stock at that point. Do not buy more. You could buy protective puts for your full position. Maybe you sell half your position and you buy puts 1-to-1 on your remaining position. Okay, there's lots of different little wrinkles. And the other thing you could consider doing is what is called a collar, where you're looking at it and you're saying, you know what, I've got a big profit in this thing. And the stock's flashing a 30 and 30 golden rule breakage. You know, I'm uneasy about this next earnings. I just am. I'm uneasy. Maybe you saw a competitor announce 3 days before, and you're like, "Wow, that wasn't too splashy," or whatever. A collar is you sell calls above the stock, collect that premium, and then with that money, you buy protective puts that are slightly out of the money. So you have a stock at 100. The perfect textbook collar is you sell an equal amount. So if you're at $100 stock, you sell the 105 calls on top. You buy with that money the 95 puts below your $100 stock price, and then it's like come what may. You know, if the stock does fall apart and you know, it ends up taking a break for the next 5 to 6 months, you know, you've bought your protection. You know, what would suck is the stock zooms up to 130, right? Because you only make up to that 105 call, and then because you've agreed to take money, but then to give your stock up above where it is now, but you've also used that money and bought protected puts. So it's collars can work. But the point is that you should always, from here on going forward, always be aware of the 30-day low for uptrending stocks and the 30 and 30 golden rule. Now, with all that said, let's go back to SDC, and we hunted down the earnings. Are the earnings, by the way, within the next 30 days? Yeah, we just wrote it down. It's February 25th. We have Friday, the next Friday, and then it's the Tuesday after next Friday. So I want to look and see if we have a 30-day low breakage, and I'm just counting this turnaround here. SDC has been in an uptrend, so I'm not talking about an uptrend, you know, including all of this. I'm just saying It's recently had big volume and price action, and the stock has been going higher. Not for that long, but it's been going higher.